Friday, May 29th, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at how one of the few certainties of this crisis, 2020 crisis, in terms of economics and what we're going to get in the future is that we're getting massively increasing debts, and we're getting also massively increasing inflation. I'm going to reference a couple of books. I'm going to look at the Bank of England data, the Federal Reserve data for the assets that they're buying for M3 and M2 money supply. But before I start looking at that, though, I need to go back to my old trustworthy Merriam-Webster dictionary from the 70s. I know many of you have listened to me talk about this, but we keep getting new subscribers. We need to get people back on the right track to understand what inflation really is. Don't listen to the mainstream media. Don't listen to mainstream economists. They don't know the definition of inflation. They've been brainwashed to think that the consequence of inflation or rising prices is inflation. So let's go to page 365 in the Merriam-Webster dictionary and look at the classical and true definition of inflation. Well, it says an abnormal increase in the volume of money and credit resulting in a substantial and continuing rise in the general price level. So it's simply, that's what it is. It's a monetary phenomenon. It's not a price phenomenon. Yes, it results into higher prices eventually. And the other book I'm going to reference, and I'm going to start with that today, is What Has Government Done to Our Money? The Case for a 100% Gold Dollar by Murray and Rothbard. There you go. You can find a free PDF in the description below for that book, or you could try to buy it as well if you want the hard copy. So I'm going to a section where Rothbard talks about the economic effects of inflation. So this is going to take a little while, but then we'll go look at where the inflation is today, especially in England, but also a little bit in the US. I am in the UK, of course. And then we'll quickly look at the markets this morning, see where they are. So let's go through Rothbard's description of the economic effects of inflation. To gauge the economic effects of inflation, let us see what happens when a group of counterfeiters set about their work. Suppose the economy has a supply of 10,000 gold ounces, and counterfeiters, so cunning that they cannot be detected, pump in 2,000 ounces more. What will be the consequences? First, there will be a clear gain to the counterfeiters. They take the newly created money and use it to buy goods and services. In the words of the famous New Yorker cartoon showing a group of counterfeiters in sober contemplation of their handiwork. And it says, retail spending is about to get a needed shot in the arm. Precisely. Local spending indeed does get a shot in the arm. The new money works its way step by step throughout the economic system. As the new money spreads, it bids prices up. As we have seen, new money can only dilute the effectiveness of each dollar or pound as well, of course. But this dilution takes time and is therefore uneven. In the meantime, some people gain and other people lose. Well, who's been gaining the last 12 years with the massive inflation we've seen? Well, it's been people at the top, the bankers, the speculators. In short, the counterfeiters and their local retailers have found their incomes increase before any rise in the prices of the things they buy. But on the other hand, people in remote areas of the economy who have not yet received the new money find their buying prices rising before their incomes. Well, that's the general public. Retailers at the other end of the country, for example, will suffer losses. The first receivers of the new money gain most, and at the expense of the latest receivers. Well, that's Wall Street. That's the City of London. They gain the most. The hedge funds, the bankers, the speculators, the government, and we, the public, gain the least. We'll pay for this, as you'll see. Inflation then confers no general social benefit. Instead, it redistributes the wealth in favor of the first comers and at the expense of the laggards in the race. So that's why you need to try to get out of paper if you have big paper savings. As I've said before, you can do that through buying precious metals, gold and silver. And inflation is in effect a race to see who can get the new money earliest. The latecomers, the ones stuck with the loss, are often called the fixed income groups. Ministers, teachers, people on salaries lag notoriously behind other groups in acquiring the new money. Particular sufferers will be those depending on fixed income contracts, contracts made in the days before the inflationary rise in prices. So yeah, you can see how this crisis in 2020 is going to greatly impact people who, who were promised something before the 2020 crisis. They're going to be hit hard in terms of their purchasing power by inflation. Life insurance beneficiaries and annuitants, retired persons living off pensions, landlords with long-term leases, bondholders and other creditors, those holding cash. There you go, cash. The worst thing you can hold in an inflation if you have, of course, excess cash or savings. All will bear the brunt of the inflation. They will be the ones who are taxed. Inflation has other disastrous effects. It distorts that keystone of our economy, business calculation, since prices do not all change uniformly and at the same speed. It becomes very difficult for business to separate the lasting from the transitional and gauge truly the demands of consumers or the cost of their operations. It's going to be even harder now with all the new costs that companies have to take on because of these rules they're bringing in because of this crisis. I'm not going to go through that in detail, but most of you probably know by now. For example, accounting practice enters the cost of an asset at the amount the business has paid for it. But if inflation intervenes, the cost of replacing the asset when it wears out will be far greater than that recorded on the books. As a result, business accounting will seriously overstate their profits during inflation and may even consume capital while presumably increasing their investments. Similarly, stockholders and real estate holders will acquire capital gains during an inflation that are not really gains at all. And I would say in the UK that's been happening already. Back in 2007, £1 was buying you over $2. Now it buys you about $1.2. So people who think their house prices have gone up, they may have gone up in pounds, but in the reserve currency, and I'm not even looking at gold because the pound has gone down even more versus gold. But if you look at your house price in dollar terms in 2007 and right now, it hasn't really changed that much, and that's what Rothbard means. For Americans, I would look at it in gold. That's the best calculation for a reserve currency, not other fiat currencies. But they may spend part of these gains without realizing that they're thereby consuming their original capital. By creating illusory profits and distorting economic calculation, inflation will suspend the free markets, penalizing of inefficient and rewarding of efficient firms, Almost all firms will seemingly prosper. The general atmosphere of a seller's market will lead to a decline in the quality of goods of service to consumers, since consumers often resist price increases less when they occur in the form of downgrading of quality. He doesn't mention shrinkflation because this is an older book. That's the other thing they do. They shrink the packages and they keep the price the same, which is de facto raising the prices. The quality of work will decline in an inflation for a more subtle reason. People become enamored of get-rich-quick schemes, seemingly within their grasp in an era of ever-rising prices, and often scorn sober effort. Inflation also penalizes thrift and encourages debt. Well, there you go. Who talks about savings these days? Do central bankers and politicians encourage people to save? No, they encourage them to spend. For any sum of money loaned will be repaid in dollars of lower purchasing power than when originally received. The incentive then is to borrow and repay later rather than save and lend. Inflation, therefore, lowers the general standard of living in the very course of creating a tinsel atmosphere of prosperity. Fortunately, inflation cannot go on forever, for eventually people wake up to this form of taxation. They wake up to the continual shrinkage in the purchasing power of their dollar or pound. At first, when prices rise, people say, well, this is abnormal, the product of some emergency. There you go, emergency. I will postpone my purchases and wait until prices go back down. This is the common attitude during the first phase of an inflation. This notion moderates the price rise itself and conceals the inflation further, since the demand for money is thereby increased. But as inflation proceeds, people begin to realize that prices are going up perpetually as a result of perpetual inflation. Now people will say, I will buy now, though prices are high, because if I wait, prices will go up still further. As a result, the demand for money falls and prices go up more proportionally than the increase in the money supply. At this point, the government is often called upon to relieve the money shortage. It's not really money shortage. It's more the shortage of purchasing power, I would say. And he does put that in brackets, caused by the accelerated price rises, and it inflates even faster. So I'm going to come to a small article that came out yesterday about that. Even the central bankers now are calling for more QE than they've already done. I'll come to that in a minute. Soon, the country reaches the stage of the crack-up boom when people say, I must buy anything now, anything to get rid of money, which depreciates on my hands. The supply of money skyrockets, the demand plummets, and prices rise astronomically. Production falls sharply. Well, we've got that in spades right now. As people spend more and more of their time finding ways to get rid of their money, the monetary system has, in effect, broken down completely, and the economy reverts to other monies, if they are attainable, other metal, foreign currencies, if this is a one-country inflation, or even a return to barter conditions. The monetary system has broken down under the impact of inflation. I admit we're not there yet, but I think we are much closer to that scenario right now. He goes on to say, this condition is hyperinflation, is familiar historically in the assignats of the French Revolution, the Continentals of the American Revolution, and especially the German crisis of 23, and the Chinese and other currencies after World War II. A final indictment of inflation is that whenever the newly issued money is first used as loans to business, inflation causes the dreaded business cycle. This silent but deadly process, undetected for generations, works as follows. New money is issued by the banking system under the aegis of government and loan to business. Well, this has been happening for quite a while now, and it's accelerated since this crisis started this year. To businessmen, the new funds seem to be genuine investments, but these funds do not, like free market investments, arise from voluntary savings. The new money is invested by businessmen in various projects and paid out to workers and other factors as higher wages and prices. As the new money filters down to the whole economy, the people tend to reestablish their old voluntary consumption saving proportions. In short, if people wish to save and invest about 20% of their incomes and consume the rest, the new bank money loaned to business at first makes the savings proportion look higher. When the new money seeps down to the public, it reestablishes its old 20-80 proportion, and many investments are now revealed to be wasteful. Liquidation of the wasteful investments of the inflationary boom constitutes the depression phase of the business cycle. So there you go. So now let's look at a recent comment by one of the Bank of England MPC members, or Monetary Policy Committee members. It says BOE policymaker calls for more stimulus to speed UK recovery. So that's the part where you keep inflating. Rothbard talks about, and that makes it even worse because it decreases the purchasing power, and there's going to be more and more calls for inflation. So it says the Bank of England should expand its asset purchase program. Well, that's QE. That's a euphemism for QE, or money printing, to limit the risk of a slow recovery that would cause longer-term damage to the economy. No, this is going to cause longer-term damage, as we know. According to a senior policymaker, well, you're going to like where this guy comes from. Michael Saunders, that's his name. Michael Saunders was one of the two members of the Monetary Policy Committee who voted earlier this month to increase QE by another 100 billion immediately. Well, they increased it by 200 billion in March, right after the crisis, the engineered crisis started, right? Dissenting from a majority decision to leave the size of the BOE stimulus package unchanged. Many analysts believe the MPC may vote to step up the QE at its next meeting in June. I'm not going to go through the whole article, just to show you that they're going to come with more. But I just wanted to show you where this guy actually works. You might think, oh, he works for the Bank of England. No, he's like an outside or external member of the MPC. So here it is. Michael Saunders is a British economist with Citibank. So he works for a big City of London Wall Street bank. And he studied economics at the London School of Economics, LSE, which is a school that was originally funded by the Fabian Society. If you don't know, Tony Blair is a member of the Fabian Society. Fabian Society espouses gradual increase in collectivism, in socialism. So that's the kind of people we have running the Bank of England and policy. And he's a banker as well at a private bank, and he's making policy at the Bank of England. I think that's a conflict of interest, but that's another story. So let's look at the inflation numbers. Some of you might be asking, well, Mario, you know, CPI is like going to zero. Well, as I said, that's not inflation. So I want to show you the numbers from the Bank of England. Let's look at M3. This is from the Bank of England. You can see how since the Brexit or EU referendum, how it's been increasing. We were around 2.4 trillion before that referendum. And I always said that that was a cover, another cover for inflating the system. And if you look at the data, that's what they did. But look at it now. Since this crisis started a few months ago, look at how it has spiked from around 2.9 trillion to almost 3.1 trillion. Now I'm going to look at the rate of growth, not the total M3. And this is quite shocking here. You can see that since 2018, money supply growth had been slowing. We'd been between 1% and 3%. Since 2019, it's really gone down quite a bit. It was between 1% and 2%, sometimes a little lower. But look where it's now. The latest data, 31st of March, is growing by 8.6%. So you can bet that is going to translate into higher prices for consumers. With the shutdown of the economy, with all the extra costs that businesses are going to have to incur, all the change in the way people do business, you can bet your pound is not going to go as far, the pound in your pocket. For the US, the best data to look at is M2. You can see how it's increased. This is from the Fed. It's growing at an annual rate, I can tell you, of around 71%. It has tapered off a little bit, the rate of growth, but that's M2. So let's quickly look at where the markets are this morning. It's 8:39 a.m. London. We've got spot gold at 17.1870, up slightly. Range has been 17.12 to 17.24. Silver is up 1 cent at 17.36. Range has been 17.25 to 17.50. Yesterday, of course, the stock markets faltered at the end of the day. The Dow finished down 150, down about 2/3%. This morning, the Dow is down 26. So pretty steady markets at the moment. The currency markets, I've noticed that the dollar is down quite a bit against the yen this morning. It's down about 0.4% at 107.20. Sterling and the euro are pretty steady. Oil price, WTI, is down 2.6% at 32.89. And to finish off, the 10-year yield continues to drop. It's at 0.68, or down about 2 basis points. So the 10-year yield still pointing to investors not seeing strong economic growth. So as I said, the only certainty about this economic and financial crisis of 2020 is that we're getting, and we're going to continue to get, greater debt creation, greater inflation, and that will mean, of course, the debasement of all national currencies, and that includes the dollar, the British pound, the euro, the Aussie dollar, all of them. They're all fiat currency. And I think that's the only certainty we have right now. How the economy is going to recover is going to be very difficult to know exactly what's going to happen. So if you enjoyed this video, please hit the like button, share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.